Hi, I'm Christine Kopr with Sotheby's Realty. What you might not know is why I got into real estate. Well, I'm a big believer in creating wealth for the long term while putting a roof over your head. And real estate is just one of those ways of getting there. And we all need a roof over our heads. So I started investing in real estate. And through that passion, I ended up becoming a realtor so I could apply everything I had learned and help others either purchase homes or make investments in the real estate market. And one of the aspects of being a real estate investor is looking at what are some of the key benefits of investing in real estate. And having a mortgage, believe it or not, is a benefit. And so today, this video is all about why is right now one of the most incredible times for you to actually have a mortgage. And this applies to particularly first-time home buyers that might be currently renting, or anybody with an existing mortgage who may have got their mortgage a couple of years ago when rates were much higher. Um, at one point in time, I think we were getting rates around 3.5%, which sounds high today, but in the grand scheme of things, weren't actually that high about 10 years ago. So let's just take a quick look at why you want to consider the option between renting and having a mortgage payment, or why you should think about your mortgage today and how it could put more money in your pocket. So, one of the first concepts is paying yourself first. And you probably heard it throughout your life that you should always be paying yourself first when it comes to managing your money in a way to enable you to create wealth over the long term. Well, I'm going to show you a little spreadsheet that can illustrate this concept. So here we go. Just going to share my screen with you here. All right. So what we're looking at here is, I'm just going to also see if I can make myself a bit bigger, make this a little bit more interesting. Okay, so here we're doing some math. I actually like math because it helps you make money, and who doesn't like making money? So here we're taking a look at a $400,000 mortgage. This is about the amount of mortgage you'd have on a $600,000-ish property if you had 20% down. So a conventional mortgage, for some of you who may not know, you can put less than 20% down to purchase a property, but let's save that for another day. Today, we're going to talk about buying, call it a $600,000-ish property, and you're going to get a $400,000 mortgage. And you might be thinking to yourself, well, why would I want to do that? It's more expensive to own than rent, et cetera, et cetera. Well, currently, the opportunity that you have right now is absolutely incredible. And I want to show you why. So on this $400,000 mortgage on a 25-year amortization, that's the amount of time you have to pay it off. You can actually make them longer. In this case, we're going to keep it shorter. And at a 3.19% interest rate, here is your mortgage payment. Now, today's rates are not at 3.19%. They're actually much lower, but I want to show you why this is so relevant to you. First of all, if you own any real estate at all whatsoever, regardless if you're paying 3.19 or 1.99%, this applies. So your payment's $1,932. Of course, for example, if you're buying a condo at this price, if you're in Vancouver, or a mansion if you're in Alberta somewhere, you might have additional costs. For example, for a condo, you're going to have strata fees that you need to add to this, as well as your home insurance and your annual property taxes. But let's just focus on the piece that really matters, and that is the mortgage payment. So $1,932. Well, every time you make a mortgage payment, that is actually, it consists of a portion of interest and a portion of principal. The interest is the money that you pay in order to borrow this money. The principal is the amount of money that's actually going to pay down the outstanding balance of your mortgage. So we talk about the concept of paying yourself first. The second that you have a mortgage payment, a portion of that, the principal, is actually just going right back into your pocket, not your landlord's. So if you pay $1,900 a month right now for rent, everything that you pay just flies out the window and you'll never see it again. If you're not renting right now, just thinking about the numbers that you have, there could be an opportunity for you to potentially refinance your numbers. Anyhow, so the key point is if you want to pay yourself first, a mortgage payment can actually help you do that. I am not encouraging you to get into excess debt that is not appropriate. But if you are on the fence and have been thinking about buying a home, today the rates are incredible. And so I want to scoot right along and show you about this. So here for this mortgage at 3.19%, your interest is $1,000.50 that you're paying every month, and $882 is going to principal. So more interest is getting paid with every one of your mortgage payments. That changes as you go through your 5-year term, the first 5 years of your mortgage. The numbers get better because obviously there's less debt. But when you get started, here's the ratio. 54% of every one of your payments is going to interest, and 45% is going to principal. At the end of the 5-year term, which is 60 mortgage payments on a month-to-month basis, your outstanding mortgage balance is going to be $343,000 and change. You will have effectively, if you start out with $400,000, you'll have effectively paid off $56,000 in 5 years. That's a savings in your own pocket, so to speak, of $11,000 per year. So I often talk with people about why is owning sometimes smarter or better than renting. And part of it is that you're paying yourself first. Essentially, it's like you're only paying $1,050 in rent and putting $882 in your pocket every month. And my question to you is right now is if you are renting, are you able to pay your rent and save money too? Because a lot of people probably will have to say no when they answer that question. But here, if you have a mortgage payment, you could actually bank $56,000 in 5 years or $11,000 a year. Now, interest rates are not at 3.19%. Here's what the numbers look like if you're even looking at a mortgage of 2.79%. It's your mortgage payment is $1,850. The interest portion of that is $918, and the principal is $933. So about 50-50 of every payment is going into your own pocket. You pay out $59,000 in 5 years, and that's banking $11,900 a year. Pretty incredible. Now, here's where it gets really special is today, emergency interest rates, they're not going to last forever. And this has to do with the fact that we've got COVID going on and the whole world has been a bit of shambles, except for Vancouver's real estate market. It defies all logic, but it's doing what it's doing. And I guess part of that has to do with the fact that we've got people who, not everybody has lost their jobs. And we have record low interest rates that people are taking advantage of. And there was already pent up demand, and there's always been a demand in buying real estate. We also have changing demographics, lots of babies being born, so on and so forth, plus immigration and companies coming here like Amazon. So here we are. Now we're coming back to this $400,000 mortgage on a 25-year IM at 1.97% interest, because that's the kind of rate you can get today. And depending on your credit history, your income, your down payment, and your specific needs, this number can get even lower, like 1.7%, and potentially even lower, which is absolutely mind-boggling, because we all know that inflation, even though they say it's about 3%, it's not, because everything is going up and becoming more expensive faster than 3% on an annual basis. So your mortgage payment at 1.97% is $1,688 a month. It's a pretty good number, actually, because I think we started out at $1,900 at 3.19%. So you're looking at a payment of $1,688. $647 of that is your interest, and over $1,000 of that is the principal. You're putting over $1,000 in your pocket every month and only paying $647 in interest, which is the equivalent of 39%. So of every single mortgage payment, only 39% is going to interest, AKA the rent you're paying for the money, so that you can pocket 62% of every payment, while you get the same benefit of having a roof over your head versus renting. Here's the part that's even better is after 5 years, you're going to pay off $65,000 because the amount of money that is going back to repaying the principal is so much bigger when you have such small interest rates. So on an annual basis, you're basically saving $13,000 or putting 13 grand into your own pocket, and you have to do it every month because it's your top priority before you buy your beer, or you go out for dinner, or you're doing whatever you're doing, and it's an automatic way of paying yourself first. So if you like what you see, give me a call, let's talk, because these are some of the exciting reasons why considering getting into real estate, if you haven't already, or buying your next investment property is something to consider, or refinancing the current mortgage that you have, or thinking about that vacation home that tends to be a bit of a trend right now because, well, we're not flying anywhere. So with that, I'm Christine Kopr. I hope you found this informative, and I'd love to hear from you. Give me a call. Talk to you soon. Take care.